Welcome to the incredible strategy of iron condors. But first off, I need to read this disclaimer to you. Unique experiences and past performance of anything discussed or demonstrated today is not guaranteed and may not indicate future results. Examples are non-representative of all trades. Certain trades may have substantially worse performance than indicated. All markets have inherent risk, and there is always the potential for loss. Today's lessons are for educational purposes only. I do not have a financial services license, nor am I licensed to give personal financial advice. So again, today's lessons are for educational purposes only. So now we've got the formalities out of the way, let's get into some great learning. My objective in this training is to teach you how to construct what I believe is to be the absolute best option strategy for low risk and high reward. That's the iron condor. So my main goal is for you to learn how to be the ultimate option seller utilizing a defined risk strategy. So if you loved bull put spreads before and you loved bear call spreads, you're going to absolutely love iron condors because they are amazing. Assumptions. Now this training assumes that you have studied and absorbed all of my other training courses and that you have understood the nuances of both short vertical spreads. That's the bull put and the bear. I should also say that you should understand everything that's in the Options Essentials video too, the very first training video that goes through all of the basic definitions, all the basic parts of an option. So what is an iron condor? Well, an iron condor is simply a combination of two vertical spreads. It's a combination of the bear call spread and the bull put spread. So let's recap on a call vertical spread. We can see up there the stocks meandering around in the middle. We're selling an 85 call, bringing money in, and then we're buying the 90 call to be able to protect ourselves from the upside. Because if you just simply write a naked call, sell that 85 call, and you don't buy the 90 call, our risk is undefined because we don't know how high up that stock could go. So on this trade, we would want the stock to stay below $85. And a put vertical spread is the opposite to that. That's selling the $65 put and then buying the $50 put for protection just in case the stock tanks. So let's put them together and then we create an iron condor. See that there on the screen? You've got a bear call spread up the top and then you have a bull put spread down the bottom. So you're getting the best of both worlds. You're getting premium coming in from the bear call spread, and you're also getting premium coming in for writing the bull put spread. And the other cool thing with this too is that it's not costing you any extra money to place the second trade. So if you place the bear call spread, you've got your margin that you have to pay. Even though you've got money coming in, you've still got margin. But if you also go and place the bull put spread, your margin actually decreases. So you earn more and you have less margin. So if you create an iron condor, you're actually reducing your margin. Why? Well, you can't lose on both sides of the trade, can you? That stock cannot close above $85 and below $65 at expiration. So that's what's pretty cool about iron condors. You can add the second trade, the second spread, and bring in more money and reduce your margin. Now, iron condors on the calls, important entry guidelines. We want to sell a call at a price that you don't think the stock will go up to. So we're going to check our resistance levels. Our strike is above resistance. Okay, that resistance is going to give us our protection. We want high implied volatility so we can capitalize on decreasing implied volatility over time. We want the expiration date to be between 30 and 60 days. We want time on our favor. We want an income, a premium coming in of 75 cents or more, because that will give us $75 or more per contract. Then we want a delta of 20 or less. That will then give us around 80% probability of profit. Now, what about the put side of it? Well, we want to sell a put at a price that you don't think the stock will go down to. So now we have to check our support levels, and we want to make sure that the strike is below support. So the support level is our protection. Again, high implied volatility. That's our IV. So we can capitalize on decreasing implied volatility over time. We want the expiration date to be the same. That's to be between 30 and 60 days. We want a premium of $75 or more, which is $75 per contract. And now with a delta, deltas are a negative. We want to have a delta of negative 20 or less. Our maximum risk or our maximum loss. The difference between the two strike prices less the credit for selling both the bear call and the bull put spreads. Therefore, the difference between the two strike prices in the example that I showed you on the charts just a moment ago is $5 or $500 per contract. And the credit for selling both of the spreads was $2 per share or $200 per contract. So we've got 500 minus 200 is $300. So in this example, you are risking $300 to potentially make $200 per contract. Our percentage return. To calculate the percentage return, you simply divide the profit by the risk and multiply it by 100. So in this example, we're risking $300 to make $200. So the percentage return would be 200 divided by 300 multiplied by 100 is a whopping 66% return. Not a bad return for a couple of weeks. So long as the stock stays between $65 and $85 upon expiration, we keep the profits. Margin. Iron condors create a credit. However, your broker will require you to keep money on hold as a margin deposit. This is a deposit, not a cost, so you'll get it back in addition to your profit or less any losses at expiration. If you close out your trade prior to expiration, you get it back upon the closure of the trade. To calculate the margin, you take the difference between the two strike prices, multiply it by the number of contracts, and then subtract the credit. The margin is usually the same as the maximum risk, but this can vary from broker to broker. So how do you win? So long as the stock stays between $65 and $85 upon expiration, you keep the profits. So which calls do we buy and sell? The nearer the strike is to at the money, the higher the premium will be. However, being a consistently profitable options trader is not just about the premium. To stack more odds in your favor, sell the call that is above resistance and buy the next strike higher. In other words, create your bear call spread at a price that you do not think the stock will go up to. And the puts, well, which puts do we buy and sell? Same as the calls, the nearer the strike is to at the money, the higher the premium will be. However, again, being a consistently profitable options trader is not just about the premium. To stack more odds in your favor, sell the put that is below support and then buy the next strike price lower. In other words, create your bull put spread at a price that you do not think the stock will go down to. Exiting your position. When your order is filled, immediately place a new order to close out your position at 50% of the maximum profit. If you've not hit your 50% of maximum profit the day before expiration, close out your position. I like to close out well and truly before the last day. Generally, I don't like to be in a trade where there's only like 2 weeks left until expiration. Why? Because when there is only a little bit of time left, you're virtually a directional trader, because the direction really affects the value of an option when it's almost expiring. Now, never let a sold put option expire in the money, or you will be assigned the stock at the sold strike price. And never let a sold call option expire in the money, or you will be obligated to deliver the stock at the sold strike price. Some repair strategies. Here are 3 options should the trade start going against you. In other words, it looks like the stock is going to be trading greater than $85 or less than $65 upon expiration. 1A, you could buy back the sold 85 call and sell the bought 90 call. 2A, you could buy back the sold 65 put and sell the bought 60 put. This is called winding out or closing a leg. A leg is one part of the trade, either the bear call or the bull put spread. 2A, if you've become bullish on the stock, you could buy back the 85 call that you originally sold and keep the 90 call, as it will increase in value as the stock goes up. You would leave the puts alone, as they will depreciate more as they go further out of the money, and of course over time. 2B, if you've become bearish on the stock, you could buy back the 65 put that you originally sold and keep the 60 put, as it will increase in value as the stock goes down. You would leave the calls alone, as they will depreciate more as they go further out of the money, and of course over time. 3A, if you are bearish on the stock and some news or an unexpected event caused it to drop, but you expect it to rise up again, you could roll up to a higher strike price. For example, after you've bought back the 85 call and sold the 90 call, you could open a new position by selling the 90 call and buying the 95 call. The credit that you bring in from rolling up should offset the loss of closing out the original bear call spread, depending on time. 3B, if you are still bullish on the stock and some news or unexpected event caused it to drop, but you expect it to rise again, you could roll down to a lower strike price. For example, after you've bought back the 65 put and sold the 60 put, you could open a new position by selling the 60 put and buying the 55 put. The credit that you bring in from rolling down should offset the loss of closing out the original bull put spread. Again, depending on time, how long you've been in that trade for time decay to be working for you. By treating your trading as a business, being a professional trader, by managing your trades, you can turn losing trades into winners, or at least minimize your losses. Some of my guidelines: the credit. If you've got a $2.50 spread, I want around 25% or more to come in of premium. So that's 62 cents. If you've got a $5 spread, 25% of that is $1.25. So I want $1.25 or more of premium. And a $10 spread at 25% is $2.50 or more in premium, because that's going to give you $62, $125 or $250 per contract. I want the probability of profit to be 70% or greater. Got that? Probability of profit, 70% or greater. And the delta, I want the delta to be less than 20. So when you put the delta of less than 20, your probability of profit is going to be generally greater than 70% anyway. Your expiration date, 30 to 60 days out in time. Take profit at 50% of the max profit, and time and trade should be between 20 and 25 days. And when there's only about 2 weeks left, I really want to be out of the trade by then. So if there's profit on the table, take it off the table and close out the position. 2 other factors that are important to determining which option to trade. We want open interest to be 100 or more. Now, when you have a look at your different stocks that you're considering trading iron condors on, you can see some with only a little bit of open interest, and you've got others with thousands of open interest. Now, of course, you want to be where all the action is. So if you had a choice of one that had 100 open interest and another one that had 5,000 of open interest, well, I'd be going for the 5,000 because it's a lot more liquid. Now, the bid-ask spread is important to look at as well. Right? We want that to be minimal. You've got some stocks and you can go and see that their options have a spread of 10 cents, 20 cents, 30 cents. you can go and look at others and they've got a $5, $10, $15 spread if they're an expensive stock. So when your spread is so wide, remember the bid and the ask spread. When it's so wide, you're losing so much money just because of the spread. So try to look at things that do have a tighter spread. Okay, let's write an iron condor. We're looking at Boeing again. Here we go, BA. And this time we're going to look at creating an iron condor. So we're going to do the bear call spread up the top and then a bull put spread at the bottom. So we want to sell the calls at a price we don't think the stock will go up to, and we're going to sell the puts at a price we don't think it's going to go down to. So we've already done the bear call before and we've done the bull put. So let's put the two together. Come over here to our trade and we can go up here to Iron Condor. This is a quick way of doing this, and click on go. And now we can see that it's going to put the sold and the bought strikes on the left for the calls and the sold and the bought on the puts on the right. So now I just go and adjust these. So I move this over. So we're doing the 115s and the 120s, selling the 120 put to bring money in, and then buying the 115 for protection. Same on the calls over here. We're going to adjust those. We're selling the 180 calls, bringing money in, and buying the 185s for protection. Now let's have a look down here. Our rate of return is $1.59, which is $159 per contract. Our maximum loss is only $341. Okay, what is really cool about iron condors is that you can't lose on both of these trades. Okay, so we've got a bull put spread and a bear call spread. So if something happens and Boeing goes up dramatically, right, we could lose on our bear call spread, but we're going to make money on our bull put spread. So what that does is that reduces our risk. Our maximum loss on this trade now is only $341, and we can bring in $159. Pretty cool. And look at our delta. We've virtually got a delta neutral, which is what we love on iron condors. In other words, getting this down to around the zero mark. So let's have a look at our rate of return. We've got $159, and our maximum loss, which is our risk, is $341. And that's our margin as well, guys. It's only $341 to place this trade. 341. 46% return. Now think about what you saw in the previous videos. When we did the bull puts and the bear call spreads, they both returned around the 20% mark. But our iron condor returns 46%. So let's have a look at our chart for a moment. Go back to that and see what we need to happen. We need Boeing to stay between here. And look at it. It's been trending sideways for a long time now. So as long as it keeps trending and staying in between here, that's how we can make our maximum return. And our maximum return on that was going to be 46%. How cool is that? So as soon as I place that order, when I get filled, I then go and place an order immediately to get out of the trade at 50% of my maximum profit. So that means I'm going to return around 23%. And I expect to be in this trade for 2 to 3 weeks. If we come back here to the trade again, to execute the trade, I simply click on Review and Send. So that's how easy it is to place an iron condor trade. That was pretty simple, wasn't it? In these days with software, we can just click the iron condor button and then it goes and puts the 4 legs for you, and you just go and adjust it to where you want. Just makes it so quick and easy. And then you can go and see the premium that you're going to bring in at the bottom of the chart as well. And then you can see your maximum risk, you can see your delta, you can see your probability of profit. Everything's all there on the screen. Pretty darn cool, hey? Now, never let an iron condor expire in the money. Never. You never let a sold option expire in the money. When a call option expires in the money, well, I shouldn't be telling you this, but just in case you've got to know, this is what happens. A call option is considered in the money if the strike price is lower than the current stock price. The seller of a call option that expires in the money is obligated to sell 100 shares of the stock at the option strike price. For example, if the stock is trading at $110 at expiration and you had previously sold the $100 call, you are obligated to sell the stock to the buyer for $100. Therefore, you would lose $10 per share or $1,000 per contract. What happens when a put option expires in the money? A put option is considered in the money if the strike price is higher than the current stock price. The seller of a put option that expires in the money is required to buy 100 shares of the stock per contract at the option's strike price. So for example, if the stock is trading at $100 at expiration and you had previously sold a $110 put, you are obligated to buy the stock from the seller at $110. Therefore, you would have 100 shares of stock in your account that are worth $100 each. Therefore, you would have 100 shares of stock in your account that are worth $100 each that you just paid $110 for. If you sold them immediately, you would lose $10 per share or $1,000 per contract. Margin call. If you let your iron condor or any trade that has a sold option in it expire in the money and you do not have enough money in your brokerage account to cover the option exercise, you will receive what is known as a margin call. Your broker will then demand that you add extra funds to your account or close open trades to cover the costs. If you do not comply generally within, say, 48 hours, your broker has the rights to close any of your open trades to cover the costs. Bottom line, guys, why do I love this trade so much? Well, we make money if the stock goes up, we make money if the stock goes sideways, and we even make money if the stock goes down. We don't care what the stock does. We don't care if it goes up, trades sideways, or even goes down, so long as it doesn't hit our sold strike. The education process. Repetition. We must watch or listen to material 5 to 7 times before we fully comprehend it. Go over it again and again. I've covered a lot in this tonight. I've covered a lot of new material here, guys, that may be over your head. It may not be, but if it is over your head, so what? Just go back and watch it again. Watch it a couple of times, and then you'll get that aha moment, the moment the penny drops. Aha, I've got it now. Paper trade. Paper trade at least 10 profitable trades in a row before using real money when we learn new strategies. Practice makes perfect. Heard that before? Well, that's wrong. Perfect practice makes perfect. That's the 3 P's of trading. See, practice does not make perfect if you are practicing wrong. So we have to perfect our practice and make it perfect. Think big. As long as you have to think anyway, how about we think ginormous? Now, if you haven't joined my online trading room yet, it could really be your key to freedom. It can take you from working 60 to 80 hours a week to only 30 minutes a day. And no, you don't have to be like that picture on the left-hand side. You don't have to have 3 monitors there staring at them, analysing everything. That's my job. Yes, I have 3 monitors. That helps me to be able to find great trades for all the people that are in my online trading room. Because what I do in my online trading room is that you're virtually leaning over my shoulder, watching me place live trades. You could be like that family there on the right, having a great life, sitting on the beach, spending 30 minutes a day adjusting your trades. I have an offer for you now with my online trading room where you'll get access to my advanced training videos and my trade alerts. $14 for 14 days in my trading room. Let me be your mentor. For today only, $14 for 14 days. You have no long-term commitments. That's purely a trial. You can cancel at any time, and I'll give you unlimited personal support. You'll get access to our exclusive Telegram group, so you can write to me directly and personally. And at the end of that 14 days, if you don't think you've received $14 of value, just send me a personal message, and I'll refund you $14 and we'll part as friends. But $14 is a very small price to pay to get access to all of my advanced training and to also to be able to join in on our exclusive Telegram group. So hit the subscribe button below and I'll see you in the members area.